today we're going to be discussing one of the foundations in accounting, the accounting equation. As you progress in your accounting career, you're going to hear the term double entry accounting system mentioned quite a bit. What that means is every business transaction affects at least two accounts. In a future video, we're going to be discussing debits and credits, but for now, just remember that every transaction has at least one debit and one credit, and that they must equal each other. So to reiterate, every transaction affects at least two accounts, and your debits always need to equal your credits. The accounting equation is essentially a simplified version of a company's balance sheet, and one of the most important aspects of a balance sheet is that it needs to balance. A balance sheet is considered in balance when its assets equal its liabilities plus owner's equity. Let's take a look at the accounting equation, as well as some of the accounts that make up our assets, liabilities, and equity accounts. So we can see here the accounting equation. We have our assets equal liabilities plus owner's equities. So assets are things that the company owns, things like cash, accounts receivable, which are when other companies owe us money, inventory, which are things that we sell, machinery, investments, goodwill. There's a myriad of other types of assets, but these are some of the more common ones that you're going to see. Liabilities are things that we owe to other people or companies. These are things like accounts payable, which is when another company does work for us and we haven't paid them yet. Credit cards payable, which everyone should be familiar with. Wages payable. This happens when our employees do work for us, but our payroll hasn't been processed yet. Or unearned revenue. So this occurs when someone pays you for a product or service that you haven't provided to them yet. So they kind of give you money up front. So a good example of that is like a 12-month magazine subscription that a customer paid you up front for. The company will slowly recognize the revenue over time as you deliver more and more magazines to them every month. Lastly, we have our owner's equity. This is essentially what's left over after you've sold all your assets and paid all your liabilities. It's what the business technically owes its owners. You'll hear terms like retained earnings, capital, stockholders' equity, or just equity. They all sort of mean the same thing, but different names are used depending on how the company is structured, which means is it a corporation, partnership, sole proprietorship, etc. But that's sort of outside the scope of this video, but we'll get into more detail on that later. So for purposes of this video, we're just going to refer to it as owner's equity. This is comprised of owner's draws, which is when an owner takes money out of the business for personal use. Owner's contributions, which is when the owner puts money back into the business. It also includes our earnings for a period, which is made up of revenue and expenses. And having revenue and expenses here might seem a bit confusing, but don't worry, we'll see in a later video of how this all sort of comes together. We're going to look at a couple examples, but first I want you to think about a couple of things when you're analyzing a transaction. These are steps that you should take when you're presented with a transaction. Following these steps will sort of help you make the right determination of where they fit into the accounting equation, as well as the effect that they're going to have on it. So firstly, what happened? Look at the transaction and make sure you understand what's happening. 2, what accounts are being affected? Does it affect cash, accounts receivable, accounts payable, an expense account? And how are these accounts classified? So what that means is the account an asset, a liability, or an owner's equity account? Lastly, how does the transaction affect the accounting equation? What accounts are going up and what accounts are going down? So let's take a look at our first example. So the owner of a company invests $100 into the business. If we analyze our transaction, we can see that we're putting $100 into the business. So if we're putting money into the business, we're going to be increasing our cash account. Cash is classified as an asset. So that goes on the left side of our equation. Since we're putting money into the business, it's also going to increase our owner's contribution account, which is classified under our owner's equity umbrella. So in this transaction, we're going to be increasing our cash, which is on the left side of the equation, or the left side of the equal sign, by $100. And we're also going to be increasing our owner's equity account, which is on the right side of the equal sign. And since we're increasing our cash by $100, we have no liabilities here, plus $100 of owner's equity. By doing some simple math here, we can see that 100 equals 100. So our accounting equation is essentially balanced. In example 2, we can see that our landlord sends us our rent bill for $5,000, which is due in 30 days. Since we're not going to pay this right away, This would go into our accounts payable, which is classified as a liability account. Paying rent is also an expense of the business, and our rent expense falls under our owner's equity umbrella. Both accounts are going to be on the right side of our equal sign, so our assets haven't been affected with this transaction. We're going to be increasing our liabilities by $5,000, and we're going to be decreasing our owner's equity account by $5,000. And since we didn't hit an asset account for this transaction, we're going to have $0 on the left side of the equation. And essentially, if we take a positive $5,000 here and we subtract our $5,000 here, essentially we have a 0. So 5,000 minus 5,000 is going to be 0. So we have 0 under our assets, and we have 0 under our liabilities plus owner's equity. So our accounting equation is still in balance. So in summary, we can see how the two equations affected our accounting equation in total. So on the left side of the equation, or left side of the equal sign, we have cash of $100. And on the right side, we have liabilities of $5,000, and we have owner's equity of $100 here for our owner's investment, and also a rent expense of $5,000. So if we do this math here, we have 100 of assets, we have 5,000 of liabilities, and we're going to add that to our owner's equity, which is $100 minus $5,000. So we have 5,000 plus negative 4,900. So if we finish that out, we have $100 of assets, and we have $100 of liabilities and owner's equity in total. So our balance, or our accounting equation, still balances. So I hope you found this brief introduction to the accounting equation helpful. Remember, accounting isn't a sprint, it's a marathon, and the only way that these concepts are going to stick is by practicing. So the more transactions you classify, the more times you do this, the more sense it's going to make to you. So thank you for watching. Until next time.